to Geared for Growth. I'm your host, Mike Mortlock, and today we're diving into one of Australia's hottest property markets, or at least in 2024 it was. Of course, we're talking about Perth. I'm joined by seasoned mortgage broker Janine Leafe to unpack the whirlwind growth that's seen Perth surge over 19% last year in 2004. We explore what's fueling that boom, from affordability and infrastructure to government investment, and whether this cycle is different from the boom and bust patterns of the past. Janine shares insights on investor behaviour, including the trend of selling down to capitalise on gains, and we ask, are East Coast buyers still running the show, or are locals stepping up? We also examine the tough conditions for first home buyers, rising mortgage stress, and the shifting dynamics of buyer demand. Is Perth still undervalued? And what could interest rate changes mean for investor sentiment? Stick around, this episode is packed with insight for anyone navigating today's fast-moving property landscape. Here's Janine. Janine Leafe, thanks for joining me back on Geared for Growth.
It's lovely to see you. Last time I saw you, we were sat on the shoreline in WA having a drink and a chat about finance.
That was the last time I'd been to WA, and I'm guessing that was quite a bit pre-pandemic, would you say?
Yeah.
Like a year before?
Oh, it was a while back. I know that definitely wasn't short term, a few years.
Well, it was back when real estate was cheap in Perth. So you're going to have to catch us up to date. Obviously, we've done 19% in 2024. So talk to us about what's changed to you, because I know professionally things are a little bit different for you. And just give us your wrap up of this whirlwind Perth market over the last 24 months. It's been absolutely bananas.
So in short, I think, so obviously we got to almost land value in WA. When you were over here, I believe that was during, it was definitely just after, because I was going mad about it, because I had sent out a property portfolio and was trying to convince people. I was like, if we all put in X amount, we could get 5 properties and we're going to just smash it. We're going to make a truckload of money. And it exactly what I assumed would happen happened, because I knew, because I've been here since 1992, you can pick when it's rock bottom. It was like, the houses were in the 200,000s. You can't lose on buying a 4x2 in the 200,000s, right? So obviously there was a culmination of things that happened in 2020, which was the global pandemic, the uncertainty, everybody was fearful. So then the interest rates dropped to rock bottom. Prices in WA went to absolute rock bottom. And because of that, a lot of people have made an extremely extraordinary amount of money. But I think that gold rush is gone. So the gold rush, I think it's just peaking now. And I was watching a podcast with you and some of your friends recently, and your accountant was saying similar things as what I think, which is we've got to that peak and now it's going to teeter off. The thing is, what I think is unusual about this circumstance, I don't think WA is in the position where we're going to have that massive crash. So I think that what people are trying to assume is that based on previous history, we have the boom and then the bust. I don't think there's going to be a bust. And that's my 2 cents worth. The reason why I think that is we're already grossly underpriced in comparison to other states. During COVID, they invested a truckload of money into Western Australia. So what I've seen over the last 4 years is the infrastructure's being boosted. The actual city is a beautiful city centre now. They've injected a lot of cash into the city. They've injected a lot of cash into buildings and everything else around it. So right now, WA's just gone through this massive explosion of building and growth, and there's still a lot of money in the state as well. So the other aspect, I guess, of it is that I think realistically, a lot of people are now selling out. So they're crystallizing those capital gains. And they're saying, well, bugger it, I've made hundreds of thousands. And the ordinary person is now saying, I'm willing to give up on X amount in capital gains and cash out and then live in a $1.5 million property with a $500,000 mortgage. And that's in line with your accounting thing. Is Jeremy? Is it Jeremy that was? Yep. Forgive us if the name's wrong.
Jeremy Yanazeli.
Yeah, he was saying similar things, which is that he's on the accounting side, he's seeing a lot of people coming in and asking for advice on capital gains and selling their assets. I'm seeing a lot of that too. So I've got my client base are mainly dual professional income families with maybe multiple properties, and they're willing to give up two of the properties just to have minimal debt but live a high lifestyle. So this is where there's this
Interesting.
new shift. Yeah, so this is what I'm seeing on the ground. And obviously, I work 24/7 in this business and I've been doing it for a decade, so I know a bit about it. So ultimately, with WA, I think we will see some more stock come to the market, and that's going to be people that are getting out because they
Yeah.
feel they've run that run. They don't want the rental income because, like, I'd rather take the capital growth than take the equity out and put it into me owner occupier or do whatever they please, but put themselves in a much stronger financial position instead of taking a rental income of $500 a week. If that makes sense.
Yeah.
So I guess
And
there's a lot going on.
yeah. And who's
Yeah.
and who are the buyers of these properties typically? Is it upgraders? Is it first home buyers, or is the expectation that other investors will come in and take their position?
Well, look, during it's shifted. So obviously during 2020, anybody that was savvy and had some cash behind them was injecting money into WA. So it sort of a lot of the East Coast buyers come over and gobble up all of our properties. Um, I
Mm.
think again that's where some of the shift might come because we may see the Eastern Coast investors say, "Well, look, this property in Perth's now worth 1 million, and that state should that suburb particularly should only be worth around 700. I'm cashing out now." So I think that there might be
Yeah.
little pockets where people go, "Have run that run, and I've cashed in $600,000. Time to get out." So it's
Yeah.
I'm not saying it's not going to be a catastrophic thing. I think it's just going to be a slow. Like people are considering now, they're saying, "Well, really, can it continue to grow as what it did in the past?" It can't. It's just not economically viable. It doesn't make sense. All the foundations of finance to me right now, I'm going, okay, if you, so buying an investment property 3 years ago, you'd be in positive gearing immediately because of interest rates and
Mm.
because of the price of the house, right?
Yep.
Now to get yourself positively geared, and I'm sure Jeremy said the same thing because I noted it, was that you're now looking at 30%. So you need to have 30% put into a property purchase to have a cash flow neutral.
Mm.
That's ridiculous. Why
Mm.
would you bother? And
Yeah.
if you put 30%
Yeah.
into a property, into an investment now, and then for some reason it drops 10% in the short term, you're in it for 40%. And then you've got to ride the storm back up. You've got to
Yeah.
ride the wave back up to get that equity back, right? So I think what we've got is a
Yes.
very unique time where this slowdown's going to come. It has to come. People aren't making enough.
Yep.
People aren't making enough money. The cost of living is still really high. So why would you go and invest 30% of your capital into something that's not going to have the quick growth that it did back in 2020 to 2024? And that it's, I'm
Did
sure
that?
you agree, Mike, that it's just that was unbelievable growth. Like
Mm.
it's an
Yeah.
anomaly,
Absolutely.
right? And
Yeah.
I hope for your sake that you bought during that time. I only bought one property, which is my owner occupier, and I'm really grateful for that because I rode the storm, and I don't think you can buy anything for 650,000 within thousands of kilometers of where I live. But it's that was just because I had to take my own advice, right? So I bought into the western suburbs, the 650,000. If you do a search now for anything for 650, you'd be lucky to get a half a bedroom with a half a car park.
Mm.
So yeah,
And
there's
yeah, and we have to remind ourselves as East Coasters that western suburbs in WA is different. It's the eastern
yes,
suburbs on this side. It's the water side, right?
yes, yeah. And it's what they call it, funnily enough, over here is the GT, the Golden Triangle, they call it, for the western
Right.
suburb, which is the nicer suburbs of WA, I guess. But ultimately, I've seen that turning point here. What I'm finding very interesting, especially in these suburbs, is you're now looking at 2 million to get into here plus. Before it was around 1.5, which still was, and I know this is ridiculously low in comparison to over east, because to buy into the
Yep.
beautiful suburbs, you're probably looking at three, well, probably not even three, probably 4, 5 million plus. But here we've now
Yep.
bridged that gap. It's about 2 million. So if I were to sell my place to get back into the same market, I would have to spend 2 to 3 mil. So that is a very interesting number for me, because I'm thinking, but there aren't that many that not here that can afford that. When you start getting into that side
Yes.
of the market in WA, there's a very few people that can do it. So my concern, and it's a hard one because obviously I've got clients that are now buying at base properties, is that discussion of, are you actually paying too much now for your owner occupier? So if you're buying in a suburb that's an hour and a half away from the city, or even 45 minutes, and it's $1 million, when pre-COVID it was only $450,000, I
Yep.
just feel like there's a bit of flexibility in there, and it may drop a couple of $100,000. It just, to live in those outer suburbs at that price point doesn't mathematically make sense to me.
Did it feel
Yeah.
like the boom was driven by the East Coast, or was there a lot of interstate domestic demand that pushed the prices? What did it feel like on the ground?
I think it was a combination of both, but majority would have been the eastern states investors, because they're more savvy in that sense. So they would have had, to them, a $200,000 property. They probably could have bought it in cash. Like they might have bought 2-3 in cash. It's funny because during that time I was speaking to a lot of people about Warnbro, and Warnbro's since come up a lot of times in a lot of statistical graphs and this and that and the other. And I thought, I bloody told everybody during that time, buy down there, because that was the suburb that was just ridiculously cheap. The only reason I knew a lot about Warnbro is because I used to live down in those suburbs when I was a child. So I know that it hasn't changed. It's still by the ocean. We've now got the train line. They've got good schools. It's a very relaxed place to live. The socioeconomics are a little bit down, but ultimately it's a safe place to be. And for me, I was thinking 4x2s and a 200,000. It was just, if I had the capital at the time, I would have loved to have, monopolised on it, but I didn't. Yeah,
Yeah,
so I
I
don't
think we're
know, I
all
guess.
billionaires in hindsight.
Yeah, that's it. But the thing was, it wasn't hindsight in my mind. It was just lack of the capital, genuinely. So I guess it's I don't know. It's nice to see that the stats now actually back up what I was trying to tell people back then. There were a few people that took my advice during that time, and they've done exceptionally well. They've now moved into the suburbs of their dreams within a short time frame, and that's what that anomaly was. I'm concerned that we've now got this massive, and I'm sure you've seen it, Mike. There's an influx of buyers agents out there now. The influx of buyers agents, to me, it's a knee-jerk reaction to seeing what's happened over the last 4 years. So we're going to see a massive
Yep.
influx of all these buyers agents. They won't be necessary over the next couple of years. I think you'll see a lot of the buyers agents fall off, because you can't keep guaranteeing that that growth that we had from 2020 to 24 is a normal pattern of behavior, and that we'll have that extraordinary growth moving forward. It doesn't happen. We've reached that. The peak might not be the peak yet, but I'm starting to see that turn. And
Well, we can see in the data the peak of growth is past, but not necessarily peak values, because Perth property prices are still going up, admittedly at a lower pace. So the peak of growth, I think, is finished, but the peak of the market is a little way away. And as you say, the $1 million question is, well, what is next? Is it going to collapse? I think most commentators are saying no, but the big fear is what's happened in the past, where we've had periods of 10, 14 years of zero growth in median house prices. I mean, we're talking about Perth as a whole, markets with the markets and all that sort of stuff. But do you share that concern that people buying now, or that have bought in the last, say, 3 months, could be sitting on something that's not going to appreciate for an extended period of time? The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
sincerely, I think that might be the case. So I think what's going to happen now is those that are bought in, like you said, in the last few months, they need to be prepared for slow growth. So, like you said, I think if anything, we might see 5-10%. It's like everything, though. You can't just put a blanket rule on each capital city. You've got your sub-markets within each city, right? So ultimately, you've got the outlier suburbs that have got lower socioeconomics, and they might be hit first, and they might go oversupply and then bring that suburb down. It's not that so if one suburb goes down, it's not going to drag everybody else with it. I think there will be pockets that might suffer more than others. If it generally comes off around 5-10% over the next 24-48 months, I think that, like you said, the values I think they'll stay similar to what they are now, but they will. We've definitely, that rush of growth is gone, but you need to be holding for 5-10 years plus. It's not a short-term hold. So if the people that are buying now, I'm asking them, is this going to be owner occupied? How long are you going to be in it? If it's investments, this is just what I've been saying to my clients: be conservative. Don't be looking at this gold rush. It's past. You really need to be aware that that's past. And if you're going to spend $1 million, you've got to be very careful in where you spend that $1 million, especially if it's an investment property, right? It's different if it's your owner occupied. There's another interesting thing that I'm seeing happen is everybody's saying the cost of living, etc. But a lot of people now, especially the young children that are coming, I say children, but they're saying the 20s, mid-20s, even high 20s, 29.
Yep.
They've been staying at home with mum and dad, and they've got $150,000 in cash to put towards a purchase. Most people didn't used to have that, right? Or mum and dad have now got so much equity in the property because they've been holding property over a long period of time that now they're just doing guarantor. A lot of the kids are skipping the lower end, so what would be a $500,000 purchase to get just into the market. That's what it used to be, right? Obviously, the $500,000 houses don't really exist anymore. But they're skipping this particular market and going straight into, I want to be in a $900,000 house for my first home. That's still a heavy cost for a mortgage repayment, right? And the kids they're pushing themselves to the brinks to get into the nicest suburb with the higher entry point. And I don't know if that's sustainable. Interest rates, right? So the cash rate, I think people really need to understand the basics of the cash rate movements and how that affects interest rates. Historically, the interest rates will sit around 2% higher than the cash rate. And that makes sense because when we got down to 0.1% back in COVID, the interest rates were sat around 2%, right? Currently, we're sat at 4.1 and the variable rate sat around 6%. So even though people are, oh, cash rate cuts are coming, yes, the cash rates will cut, the cuts will come. To what degree, we don't know, but we can assume that it may be 0.25, 0.5% basis points, which is a 0.5% for those that don't really understand cash rates. And then if that is the case, you think, well, 4.1, take away half, 3.6, plus 2%, the interest rates are still going to be sat at the 5.6 anyway. So it's not that much different. We're not that far off. And is a 0.5% on somebody's home loan actually going to make a difference in repayments? Not particularly. So I think people need to understand that as of today, and I think this is why that podcast was the 2025 is going to be a dangerous year, right?
People sort of saying interest rates cuts is going to change the market. Well, if we only get 25 basis points and then we wait a few more months and then we get another 25, well, okay, well, 0.5%. Well, is that going to change borrowing capacities and serviceability? Well, yes, but in a meaningful way, and not really.
Yeah, 100%. It just, none of it makes sense to me right now, right? We've got ultimately even that, like, just a minor cut is not going to affect anyone because the cost of living is still so bloody high. So the thing is, people are just going to probably want that to have just a little bit of extra cash flow coming in. So the interest rates, it's just, it doesn't have that impact as it would before. And the thing that bothers me, right, is that people are saying interest rates are so high. They're not so high. They're really not. Like, let's be honest. In a historical context, the average would be sat around 4.5%. Like, get over it.
Mm.
And if you think if you are
Yeah.
struggling, or you are so price sensitive to market adjustments with the interest rates, then things are bad. That means you should be looking at your financial position and saying to yourself, why do the interest rates affect me so much? Because the only thing that's going
Yeah.
to change borrowing capacity is if the lenders come off if they change that to 3% buffer within the calculators. So if they if they reduce the buffer,
Yes.
that's what's going to have the actual impact. So if we go down to a
That
2%,
that was actually my next scribble, the APRA
yeah,
floor. I did want to ask you about that serviceability floor because I'd heard that was being considered as being adjusted because it comes from a different time, right? It comes from when we had so much heat in the market and such a high percentage of investor interest-only loans, and the trajectory for interest rates was up. Now it's like, well, it's definitely not up. Well, no matter what it is, it's not really up. So is it fit for purpose, like a 3% difference? I think there's a strong argument to say no.
it is. And I don't think that they're going to relinquish that buffer for a while, because I think that APRA is looking at, they've got some data that we don't have, and they're thinking we need to keep it at this for a while. I think I'll be surprised if the buffer changes this year. If it does, I think it's actually going to be detrimental, because I think that what's going to happen is if the buffer comes off and then we have a half of as like so 0.5% basis points reduction, that will overheat the market, because people go, well, a combination of both. They're like, well, now I can borrow more and the interest rates are a little bit cheaper. People might just get starry-eyed and drive things up, but it's unsustainable. It's unsustainable because people aren't earning more money. People aren't earning more money, and you can't have all markets inflationary as they are right now. You can't have the stock market up, the real estate market up, the commodities markets are up. Every market is hot. That means that something's got to come off. So I think to me, I'm just like, no. I'd be weary. I'd be conservative. I'd just be looking at what you're doing now, or just wait for that. Wait for the market to pull back. But I don't think anybody needs to rush buying property. That's my 2 cents worth. I don't think people should be rushing to buying property
I like
unless it's
that.
occupied. I think people need to calm down. It's done. It's over for the short term. The thing is to purchase. Look, I'd be looking at it myself right now and going, if I was to buy something right now, it'd have to be a long-term hold. But it's also, you've got to look at the cash flow situation. Most people that are buying at the moment, the younger kids, I'm looking at them and I'm saying to them, I know right now you're not engaged and you don't have kids, but you will. So how's that going to impact your situation? So when you're buying this $1.5 million house because mommy and daddy have given you $500,000 of cash or whatever, like you've still got $1 million debt. And then if your partner's not working, then what? Because you're 29, your partner's 28, and then she'll want kids in the young 30s. There's just a lot. I don't know. When I had that gut feeling, so in 2020, when I was telling everyone just buy as much as you can, the stock markets also came off 30%. And I was saying to everyone, get that free cash, put it straight back into the stock market. You're going to recover that money and some. And people did. You made 30-40% immediately because it came off 30%. And with the stock market, when it has those hard crashes, it's always going to rebound. The right now, it's like you said. So Perth's, well, I don't know. Perth's not outperforming Melbourne, but I do believe that Melbourne is actually a good spot. I think Melbourne is actually a good investment. I think Melbourne would be a good investment moving forward in the current climate. That's the only market that I can see that has actually probably got a little bit of lift in it. Because I think what happened with Melbourne is they're underpriced because of what happened during COVID and because of the policies. And now that it's starting to recover, even though it bottomed out, but now people are going, Melbourne's bloody awesome to live. And now they're coming back and actually got the interest there. So Melbourne should come back to where it was before, which is second place to Sydney. That's usually where it sits, right?
Yeah.
Unless I'm wrong.
Well, I mean, I always say that, but Canberra sits in the middle of the two, but we just tend not to talk about Canberra because it's weird and it's full of public servants and it's just a paddock that grew
Yeah,
into a city. But yeah, normally Sydney and Melbourne are in that kind of lockstep. So now it's the big question about, well, is it just a case of mean reversion and it's Sydney's time like it was Perth's time, or is the Victorian economy in such a state that it'll actually take a number of years to recover? And there's a few commentators that are suggesting that as well. But I
yeah,
mean, it's hard to ignore when the median house price in Perth is now higher than Melbourne, which is very unusual.
exactly. And then if you're looking at historical data, you've got to say that's why is it unusual and does it make sense?
Mm,
And then you say, well,
mm,
that to go back to where it should be. Melbourne has to trump Perth at some stage. At the end of the day, we're a young city. It's a beautiful place. I love living in
mm,
Perth. It's very safe. It's great to raise a child. Lower cost of living to some degree. But then you go, but Melbourne's massive. Melbourne's got so much more to offer. It's got a lifestyle. It's like
mm,
people, it's either Sydney or Melbourne people want to live. Melbourne has to come back. So the thing is, if I was to put my money anywhere right now, it would be Melbourne. I would go Melbourne. I
mm.
wouldn't. Perth,
Interesting.
yes, for me, if I'm upgrading into a nicer, bigger owner occupied. But nah, not in terms of investment.
That's
Because
different.
it's just I had a client purchase a $1 million place yesterday and I said to him, I was like, are you sure? I was like, that suburb in my head, I was like, I wouldn't. But you can't tell them. I was like, I feel like
Mm.
that should
No,
really be
you
valued
can't.
at 800,000 at most. But we won't know right until the next 12 months has occurred. But I don't know. That's just what I'm saying. But there's just too much noise, too many people telling people to buy in certain places. There's a lot of stupidity out there. And my other concern with that is these people that grow these social media platforms and then they have legitimate massive following the followers, they will be swayed by whatever they say. So if they say buy in this particular market, I actually think that that will have an impact on that market because if you've got this cult following, they're like, well, he says this is the next place that's going to go off. It's self-realization because if they do all start buying in there because he's said to buy in there, then that makes him look like a god, but he's not a god. It's a
Mm.
I
We talked
think we're in
about
a
that a little
really
bit in and the other night we were talking about that, about how people, can announce a certain location. They'll bring a certain number of investors. There'll be people listening to them. They'll jump on the
yeah,
bandwagon, and people can actually influence property markets, especially if there's a population of 30,000 or less. You get 300 or 400 people buying into that location. It makes a difference.
yeah, and I don't. The thing is, it's like how you can't monitor that. There's no way to know if what they're saying is genuinely having an impact. But my all I can run off is my gut because I don't have the raw data. But I'm pretty sure that what they're saying is impacting people's decision making, and it scares me because when I saw what happened with the Pilbara back all those years ago, when they were valued at the 1.2, and people were guaranteed $2,500 a week rent and then those properties went down to 200,000 and people lost their whole livelihoods. It's just
Yeah.
it's giving that vibe to me. There's certain things I don't, and I was like, you just gotta look at the bare fucking facts, the facts and figures, and they speak for
Yeah.
themselves. It's cost too much to get an investment property now, and you'd
Mm.
want to see
Yeah,
that return
absolutely. And as
in
you
in
say,
that.
a negatively geared one.
Yeah, you'd want to see the return in either your yield or in the growth. And right now, you're not seeing the rental because it's so negatively geared. You're not getting any return, so you get no cash flow negative, and even with your depreciation and everything else, it's still not stacking up. You're still down every year that you're
That's
holding
true.
it, hoping for this capital growth. And if you're getting told you're going to have 200% return in 2 years, that's not happening. So you've got to look at it and go, okay, I'm taking this for a reason. Maybe you're earning $250,000 plus, and you want to take that, the deductions to reduce your taxable income, blah, blah, blah. That I get it. And you can sit and you can hold it, but you've got cash flow, right? But most people don't
Mm.
have that spare cash flow, and
Yeah.
there'll be little one minor inconvenience away from having to sell things. I think because they'll have to sell
Yeah.
assets to be
Yeah,
able to.
that's the concern.
Yeah, but
Yeah, absolutely.
that was an absolute ramble of mine. But I think you know what I mean.
Well,
I'm just scared. I'm scared for
yeah,
people.
it did. Yeah, I know, and I think that's all I've been sort of trying to get across. It's not necessarily that I'm pro or anti Perth. I'm pro being sensible and not exposing yourself, and not treating it like what's happened last year is just what's going to happen this year. And it's a dangerous time. We're definitely not at the peak for Perth, but it can't be very, very far away. And what's on the other side, no one really knows.
No, they don't, because it could be some random thing that none of us can foresee, and just like COVID was.
Mm.
But the thing is, when those global issues happen, like generally people go into fear mode and generally markets will collapse. So that's a common theme. So if you do not, next time you go, hey, I'll be looking at it going for a different lens, which is global pandemic. Great, it's time to buy up if you've got the cash, if you've got the
Yeah,
free equity.
yeah,
You've got
yeah, yeah.
the thing is, it's that fine balance of making sure that you're prepared for those times. But people, human nature has a common thread, and right now, I feel like everybody's just, I'm in the money, we're all in the money. I was like, you can't be, we all can't be doing so well. And it's just the
Yeah,
unfortunate truth, that something's going to come off. I wouldn't even bother talking
mm,
about the crypto part because, yeah, it's
for
just,
sure. Yeah,
I think that, look, people that I know that are savvy, we're all concerned for particular reasons with what's going on in the current market. And the common theme as well, and you'll enjoy this, is that when I went to Sydney last in December, I was talking to the Macquarie economist, and I brought up the savings scenario. So during COVID, I think people forget that there was 22 trillion in savings because nobody was spending. Those savings
mm,
have rapidly depleted, and they're near now gone. So and I said,
yeah,
so
yeah,
what happens then? Because people have been relying heavily on the savings because of the cost of living. Now that the savings is gone, that's when the assets have to be sold off if people are still struggling, because people are still struggling. And he said, "You bang on." And I was like,
yes,
"Thank you."
yeah,
And he's not the only economist that's agreed with me. I've sat with 3 other economists over the last 6 months at dinners, private dinners, etc., and they've all said the same thing because I've brought up the savings. I said, "You keep avoiding the savings." I was like, I was like, why did it rapidly deplete over 4 years? So it grew rapidly, depleted rapidly, and then you come to a certain inflection point where people are going to say, I'm going to have to sell my shares because I can't afford to live. I'm going to have to sell a
yeah,
property because I can't afford the mortgage repayment on my own house, let alone this investment property. So I think that that's the next bit that's coming. I just need to get those numbers, and I'll have a look at it, because I was actually going to look at it before we spoke today, but maybe we can talk about that at the next one. I'll get some graphs together. I've got some interesting ones that you'll like from the ABS, different to the ones that you used.
oh, good.
But and I
Yep.
think
Okay,
that
good.
that information, yeah, sheds a bit of light on the stuff that I'm talking about as well.
Because the household savings ratio, we do know, went through the roof during COVID because the government stimulus, not the people didn't lose their jobs like they were expecting. We didn't get 30% unemployment, which was
Yeah,
in some of the forecasts. And then it's like, well, I can't go out to dinner, I can't go overseas, like I can't spend my money, so it's just kind of sitting there as a war chest. And then we get let out, everyone buys a tinny and a caravan and goes to Bali and buys a Range Rover, and then
yeah,
suddenly now we're here where we're like, okay, well, I haven't got much savings, and yeah, what's going on? Oh, yeah, properties are costing me more, my wage isn't going up like it used to, everything's expensive, my insurance premiums are through the roof,
yeah.
if you're rent's a problem. So yeah, you're right, it kind of begs the question, where is the relief coming from? And is 50 basis points enough relief? Probably not for a lot of people.
No. And that's why I was saying, like, so whenever I've brought it up with the economists, and these are like senior economists, so I understand the basic fundamentals. So when I'm asking them, I want their opinion, and they agree with us, because I said to them, ultimately, people have been tapping into those savings because they've got the savings sat. So if you've got 50K sat in the offset or whatever, 100 grand, and you're struggling to just do you've got your monthly outgoings, which are increasing, and your income's not increasing at the same rate, then you're going, well, I'll just take a little bit. Next thing, you've depleted it. Then what's next? Because something hasn't changed in your circumstance financially and cost is still going up, then you will start selling off assets. That's generally what people do. That's normal human nature, because you won't go. A lot of people get ashamed if they're struggling. They don't want to talk about it. And they will try everything to help themselves before they go and seek help. So, and that usually comes with the offloading of assets first. And then if they come into strife still after that, then they'll go and seek help when it's like when they're in the real dire straits. So for me, I'm very intrigued to see where the savings levels right now. Because say, for example, if it's gone from 22 trillion and now it's like 2 trillion, but then it's starting to tick back up, that might be a positive thing. So that might mean that actually, okay, people are doing okay again, but if it's still trending down, that's going to be a problem.